Hello, hello. Hopefully everyone can hear me. My name is John Gallo, and this is the 18th of March, 2022, and we're having a noon coffee chat at Gallo LLP with my guests from FSG Financial Services Group, Michael MacPhail and Scott Kwasnecha. I'm very excited today to be here to talk about benefits with these two experts. I let them talk and me really moderate, because I think this is certainly what we've been seeing in our practice lately, is a lot of people asking about, what are some of the other things we can do when it comes to benefits, either from a staff retention perspective, or just there's a lot of more people that are sick nowadays from a multitude of things. So a little more about Mike and Scott. Mike and Scott are the owners of FSG and a couple of subsidiaries called getbenefits.ca. They have offices in Leduc, Sherwood Park, and Lloydminster, and they service clients throughout Western Canada. We work closely with them, and I'm proud to present the two of them. Mike, Scott, why don't you kick it off and introduce yourselves?
Perfect. I guess I'll take the floor first here, Scott, if you don't mind.
Yeah, go ahead.
So yeah, Michael MacPhail. Scott and I are business partners with two companies, Financial Services Group and Get Benefits, which is formerly Kanaswich Benefits Consulting. Basically, I run our benefits and group retirement division.
I got some comments in the chat box, Mike, so I'm just going to throw out there. They want to know what you guys do for fun.
I love to golf and ski.
Yeah, I play hockey on two teams in the winter and try to golf, but not very well in the summer.
Okay, so today's topic is flexible spending accounts, which we've comically coined as the holy grail of employee benefits. Okay, flip slide. Here we go. So yeah, so this was an intro on the slides here. Basically, again, two firms. So Get Benefits, we have offices in Sherwood Park, Leduc, Lloydminster. We primarily focus on small to medium-sized businesses located in Western Canada. On the flip side, FSG is more of our personal division, so personal financial planning, insurance, and investment management. Been in business since 1977 and has gone through, started as a family business, went through its transition with Scott and myself in recent years. And then we added our benefits division last year, which we bought out another consultant. So flex spending accounts, what does that mean? So a flex spending account is made up of two separate spending accounts. The first one is a health spending account. The second one is a wellness spending account, or otherwise known as a taxable spending account. You could also mix in some other RSP or group retirement options in there as well, but for today's presentation, just want to focus mainly on these two. So health spending account, defined as a tax-free benefit for health services such as dental, vision, other professional services like physio, chiro, massage, that type of thing, and any other eligible expenses granted by the CRA. And again, the CRA is key here because this is tax-free to the employee and still an expense to a business. On the flip side, the wellness spending account or taxable spending account is a taxable benefit. It's a broader range of wellness services and offerings, and that's customizable by the employer. And any claims or reimbursements made there are reported on an employee's tax slip. So that's the key difference, okay? And obviously we'll talk about more in later on in this presentation. Okay, for anyone who likes memes or familiar with this Vince McMahon meme, it's one of my favorites, so I had to throw it in here somewhere. So why do we consider this the Holy Grail? Well, first of all, employees love it, employers love it, and it's cost effective. So it's a trifecta when we get all of our questions and surveys we do. This hits all three. And a bit of history here. Health spending accounts specifically, but flex accounts as well were really reserved for larger entities in the past, so 500 or more lives. However, recent improvements in technology and some innovation by market disruptors have really brought this offering and made it accessible to small and medium-sized businesses. And one of the biggest hindrances in the past was for the large carriers, Manulifes and Sun Lifes, these spending accounts aren't big money makers for them. The margins are very small. The admin fees are small. It's really dollars in, dollars out. So there's not a lot of smoke and mirrors where they can pad their premiums with. So it's really taken a lot of smaller companies and innovative companies to say, you know what, we can make a go at this. We have a leaner organization. We have less overhead costs, and we can focus on this, specialize in it, and we can make money. And we feel it's a good offering. So that's really the biggest difference in the last few years that we've seen bring this to smaller and medium-sized companies. So why do employees love it? Well, first of all, it gives them a say and flexibility on where to spend their benefits dollars. It's convenient. It's a user-friendly digital platform. They make their claims on there. You just snap a quick picture, input your claims details, and within a few business days, the money's in their account. And it's a simple, straightforward offering that can be used to top up their existing plan. So this is not something that has to replace their existing benefits plan if they already have a primary plan. Typically, we see this most of the time, we see this used as an add-on. So it's used to enhance their existing plan. Why do employers love it? Well, first of all, it's cutting edge for small and medium-sized companies. It gives you the ability to set yourself apart when you're hiring or retaining staff. We have a few slides. I didn't include them in here, but some benchmarking in terms of how many companies right now offer a flex spending account to their employees. In Western Canada, that's under 25%. For small businesses, it's about 7%. So think of that. You can be one of, let's say, 10% of companies actually offering this. And in my opinion, that's a great way to set yourself apart, especially on that younger demographic. So if you're a company looking for millennials or even younger demographics, this is really, really popular with them. Again, it's very simple and easy to manage and administer from the employer's standpoint. It's basically a dollars in, dollars out. There's not a complex plan design. You basically give a budget every year per employee, and they use it, they lose it. Aside from, setting the employee up when they get hired or taking them off when they're no longer with that company. Other than that, it's pretty straightforward and very easy. And again, one of the most popular things with employers, it's cost effective. In fact, this is the most cost effective way to fund your benefits plan. It's an 8% admin fee. And that's only made when at the time of claim. So there's no setup fees or account fees, and it's fully transparent. Again, there's no smoke and mirrors here, which is very popular. So benchmarking, right? So there's two main plans that we look at. One is, like I mentioned earlier, a top up. So if you already have an existing benefits plan, for the HSA component, if one of your employees goes to the dentist, the primary plan is still going to take that first claim. So they're the primary payer. If there's a copay or if there's any gaps in that primary plan that aren't covered, then the HSA component would come into play here, and they could claim that there. The taxable or wellness claims, this would still be the primary payer. And on a top-up plan, we typically see a lower amount as we're already giving them coverage elsewhere to their primary plan. A standalone plan, and sometimes we refer to standalone. It can be, this is all we offer our employees, but it can also be as part of a hybrid plan. So what I mean by that is if you still have life insurance, disability, and even drugs and certain other things that would be part of the core traditional benefits plan, you could carve some of those things out, like dental, vision, some of the more dollars in, dollars out, and you can bring those into a spending account. And the main reason there, you're just reducing the cost of administration there. In a traditional plan, you might be looking at 20%, 25, 30% in some cases, reducing that down to 8%. And in those cases, the HSA would be the primary payer for any of those eligible claims under the CRA guidelines. And then again, the WSA claims primary payer. And we would typically see higher dollar amounts per year, as this is the only coverage we're offering for those benefits line items. And to give you a snapshot of what that looks like in terms of dollars, on the top up side in the middle column here, employees, and by this I mean most your typical employees, so anyone who wouldn't be considered management and or executives. For a top up plan, we would usually see between 500 and 1,000 annually. Management, you'll see that bump up to 1,000 to 2,000, and executives, again, anywhere from 2,000 to 10,000. And I know that's a pretty wide range there, but obviously there's so many factors that come into play here. I mean, are we talking about a company with 3 employees versus 100 versus 500? There's obviously some big differences. On the standalone side, employees 1 to 5,000. Management 3 to 10, and executive class 5 to 20. And 20 is usually the max we would see on a spending account, and I can talk about that a little later as well, and the reasons why. So for shareholders and small business owners, and this is maybe more on the health spending account side versus the flex or wellness side. If you are a small business owner, you must be incorporated, and that corporation has to be generating revenue. Okay, so if someone's retired and they have a holding company still that all their money's in and they're just depleting it and during their retirement, and they're living half the year in Florida or whatever, that's not really what this is designed for. This is designed to be an employee benefit, okay, not a shareholder's benefit. And there's a few tests that if you're ever audited, we want to make sure we cover off. And we would typically suggest a health spending account only for business owners, because the WSA is taxable to that person as an employee, and it would force reporting on that T4 slip every year, which we may not want, depending on what your accountant, John and the team want. They may not want that automatically going towards your a taxable benefit on your T4. And like I said, so HSA plans are meant to be an employee benefit, not a shareholder's benefit. I'm going to try and pull up this tip sheet. Hopefully my technology works for me.
So I'll open up. Maybe if anyone has any questions, you can either just jump in or raise your hand, and I'm more than happy to kind of hear you out or facilitate any questions. While people are thinking, maybe I'll ask the first question, or certainly note something that I've seen with health spending accounts, and it's around the different levels. I think that's a really good point, Mike, on particularly on owner managed businesses and how much. Have you ever seen any sort of issues with CRA with these?
I mean, we haven't personally. We are pretty good with setting things up properly and documenting things properly. I have seen some case law just in terms of, that's hit the news or whatever. And that's just typically primarily, a business owner who's the one that comes to mind is a guy out of BC, actually in Whistler. He had a little shop in Whistler, and he went and got a big knee surgery down in the States and tried to submit that through a personal health spending plan, and ran into some issues there in terms of it being determined it was a shareholder benefit, not an employee benefit. And it wasn't done properly. Now, that's not to say that going to the States and getting a surgery can't be submitted and claimed properly. It's just that the way his plan was set up, it didn't meet the definition of their criteria. So,
yeah, thanks. That's a great example. Certainly, I've seen a lot of our clients head down to the States just because of wait times and what have you to get those knee surgeries. I think Palm Springs is one of the places where people tend to go.
So I'm going to, John, if you don't mind, I'm going to share my screen again and just kind of Go back to my sheet here. So on that note, which we were just discussing, so the limit for shareholders has to be reasonable. And when they say reasonable, typically that would be 10 to 15% of income of a fairly compensated employee in a similar role. Okay. So, you know, me as a business owner, I can't just put whatever I want on there. It would have to be similar or reasonable. What's industry standard or what would be considered reasonable outside of myself being the owner, but me as the employee. Now we say here that they must have T4 income. This isn't a must. If you don't have T4, we just want to see a letter from your accountant, basically outlining a few things. Primarily, again, that is this person actually an employee in the business, first of all, and is it reasonable? The amount we're giving them, is it reasonable based on the circumstances of their employment? And there's a couple of quiz questions here, which I don't really need to go through, but basically around if you have family members, a spouse or a kid that's also on the plan, we want to make sure that their amounts are reasonable as well.
Yeah, one of the things you had mentioned, Mike, around, you know, your sense as employees love it. Certainly, we're seeing a lot of methods and techniques to try to attract and retain the employees that people have. I think everyone knows, particularly in the Alberta market, it's tight right now. And if you can provide these sorts of benefits, it's certainly just one more thing that, you know, ties into corporate culture and helps retain people. That's certainly what a lot of our clients have been using them for.
For sure. And honestly, by far, over the past 2 years, this is the most popular program that we've seen. It works. The best thing about it is it's so versatile. It works from an employee, or the WSA not so much, but a spending account in general works on anything from a company of one life up to hundreds or thousands, right? Thousands wouldn't be our market, but you know, up to 500 lives. This is by far the most popular plan we have. Anytime we do a survey, anytime we meet someone new looking for something different, anytime we roll this out to employees, even, everyone's minds are blown of how flexible and the actual utility of it for both the employer and employee. So, okay, so in terms of some examples of eligible items, again, under the HSA, this is non-taxable. So expense to the business, not taxable to the employee. CRA has guidelines. Typically, again, anything that would fall under your regular benefits plan would be eligible here, as well as some additional things, you know, Invisalign, some other orthodontic stuff that might not necessarily be under your traditional plan, as well as some additional paramedical offerings, some maybe more obscure practitioners, some acupuncture or holistic type stuff could be covered under here. Again, I have a little.
One of the questions that we've had clients ask us around, you know, and this is an unfortunate kind of outcome of maternity is what about drug rehab for children, say for adult children or children of the employees and stuff like that? Have you seen that?
Like rehab, as
rehab, yeah, sending a child to rehab, saying Kelowna, those could be very expensive sort of propositions.
Yeah, so it depends. So there is coverage available, but again, the tricky part here is if it's for family, John, we have to be very careful that if we're allowing our family member to do it as a shareholder, we would have to treat our other employees in a similar manner. So we would have to be just careful in terms of how it's set up. And
it could be a slam dunk for an employee's child that has no relation. Yeah. Okay. Let's hope no one has to do that, but I've had that question before.
Yep. Okay, and then on the wellness side, again, this is customizable by the employer, and the main reason why is there's no CRA complications or guidelines there. Okay, and the reason why an employer would do this versus just giving a salary bonus or something is you can target the dollars you're giving them. So it's not just another bonus that everyone gets and everyone forgets about the next year. So it's a difference of perception almost in terms of, look, we care about our employees' health and wellness. We want to offer you guys, you know, gym memberships or sporting equipment or fitness equipment. All these types of things we can tailor. and make available to your employees. And I do have a couple items here. I guess maybe we can just email these after if anyone wants to see, just in terms of what the guides look like of what we have in a typical or standard plan. And you know, the other side there is, so that 8% admin fee applies there, but when you think of giving them a bonus, you're still paying all those ancillary costs with salaries, right? So really the cost difference isn't that much either. So it just gives you a targeted way to reward your employees that, you know, are outsiders, just another bonus. So the provider we use, they're a provider called My HSA. They're actually out of Calgary, and they are great. They have basically a digital platform. They have apps, or you can go online and you can submit claims through there. Again, a lot of good feedback. They have a live chat line, which they answer their chats within 30 seconds. Anytime I've gone on there, we have rarely we have of complaints about this provider. And just some info on them. Again, their platform, they have an app, very quick reimbursement. The claims are done within 2 business days, typically. They have a program called My Provider, which will help you source all providers in your area based on your GPS location. Fully transparent dashboard. So any reporting you want, monthly reporting, yearly reporting, tons of reporting options available to you. And in terms of the formal presentation, that is it. So obviously happy to answer any questions with HSAs, WSAs, or anything else. Benefits here, a couple examples I've put in there. You know, one of the main questions we do get is in terms of benefits packages, self-insuring versus traditional insurance, hybrid models, like what are the benefits there? So yeah, happy to answer anything anyone has.
Okay, Mike, I'm going to take back screen control here and just open it up for questions from anyone. Don't be shy. Okay, well, while people are thinking about this, maybe I have a couple more questions. So, the 8% admin fee for an employer, how does that work? What do they see?
So they would just see the total amount. So I can just give you maybe an example. So an employee goes to the dentist and their bill after they go to the dentist is $100. So they pay their $100 at the dentist. They go on their spending account and they claim $100. So then the employer or company basically just gets an invoice for $108.
Okay.
Is there GST?
So sorry?
GST on that 8 too, or
on the admin fee, correct? So you know, $108.50 or whatever the HST.
Cents, yeah,
there you go. So 40 cents would be applicable on the admin fee only, not the total claim, just the fee. Okay. Yeah. So then, yeah. So essentially, the company just gets an invoice, and then it gets automatically debited from their account, and gets deposited into the employee's account at the same time.
Okay.
So again, it's a dollars in, dollars out. So it's you know, in a traditional benefits plan, you pay premiums. You know, you pay $300 a month for your premium. You go to the dentist, it all gets claimed kind of in the background, and then next year at renewal time, your benefits premiums go up or down. Typically, that's always up, but that's how a traditional package works. Whereas this one, it is literally dollars in, dollars out. You give your employees $500 a year. If that $500 is spent, it's gone, it's gone. Employers, you know your budget, but yeah, it works on a claims pay-as-you-go basis. For larger companies, you know, we can set it up for, you know, maybe on a quarterly basis or whatever, but typically most of our plans are all pay-as-you-go.
Okay. If you're shy from asking a question, just type it in and I can read it out. That's not a problem. Another question for you, Mike.
Yeah.
From an employer's perspective, I've heard in the past sometimes employers are required to kind of prepay the HSA. So if they have 10 employees and they're given $500 a year, the HSA say, well, you know, in order to give that 24 or 48-hour turnaround to your employee, we would like to hold $5,000. Is this what you do as well, or how does that work?
So while that's still an option, we prefer this arrangement, the pay-as-you-go arrangement, I guess. So my HSA specifically, it is pay-as-you-go, and there are other providers, and we do use like QuickCard, for example, we would use, and that is based on the model you pointed out. But honestly, you're just, I don't like that for a few reasons. You're giving your money over to everyone, or sorry, not to everyone, to another company, and they hold on to it, they control it, they're getting the interest, as small as it might be. And then at the end of the year, you kind of, well, do we have to top this up, or do we get our money back, or, so, assuming your company can float the cash flow ebbs and flows of managing a program like this, we typically suggest a pay-as-you-go model. That way you are always in control of your money. And it's not like you have to cut a physical check every time, right? So this is all done automatically by direct debit. So the invoice, you get an email on Wednesdays and Fridays. Here's the amount that was claimed. It's being pulled Friday morning. So you got a couple of days to fund your account if you need to. Yeah. But we've never had any problems with our clients complaining about pay as you go versus billing every month.
Typically, one thing to add to, we do see some spikes from time to time, John. Like if you have like a, December, or calendar year for your benefit period, because the yearly, say if you give each employee $500, it resets every year. So if your renewal is calendar, for example, we often see a lot of claims come out in like January, because people are maybe going to go, especially on the WSA side, they want to go buy like their gym membership or their new treadmill, or, you could potentially see a spike on that side. So like Mike said, as long as you're, able to carry those potential spikes, like we'd rather do that versus like a certain amount of money every month.
Mm-hmm. Okay, we actually have a question. So I'll just read it out. Hi, I'm in a biz where I have more contractors versus employees. Is there an option where they can pay for a portion of either an HSA or WSA, and would there be a tax benefit for them?
So
I guess.
Yeah, so contractors are tough. So our general advice when you have contractors is you want them as far away from the term employee as possible. Okay. So and again, this is maybe a discussion for you, John, on your end there, but I typically recommend you as an employer offer zero to your contractors in terms of what would be offered to your other employees. Again, just to avoid muddying that line. If that contractor is set up with their own corporation, and depending on how they want to take out money from that corporation, then they can have their own spending account. Okay. So it really depends on a few factors, but typically speaking, while there might technically be some availability for contractors, we try to avoid it as best we can.
Yeah, I think, Mike, that's quite wise. I just want to add a point that I think to the individual who asked the question is that, one of the reasons why you may have contractors is for, de-risking or what have you. But then when you start treating like an employee, you risk a bunch of CPP and EI issues. So any benefit that might come of having a contractor could be wiped away if you ever got a negative assessment on CPP or EI. But Mike or Scott, is this not true that perhaps the contractor could see you even if they're not incorporated and potentially get a health plan as an individual or something like that?
Yep, for sure. And just one more point there, John, on that. Whoever asked the question was, if the concern is I want to offer a little more to that contractor, if you're going to give them $1,000 spending account, just pay them more. Just take that $1,000, break it down. If it's $80 a month or whatever, just pay them that money a month in whatever way you're already paying them. That's the simplest way I would say.
$80 a month administration fee or something like that, and they can buy that program.
Yeah. And one thing, John, you know what? I just want to point out too. So I didn't include this in the slide. I guess I should have, but with the flex account, There's actually a window. So there's a 30-day window at the beginning of every renewal period. And again, that's a year. So let's use January as an example. So the employee does have to allocate portions towards the HSA or the WSA one time a year. They cannot change it mid-year. Okay. And this is the CRA says this has to be part of the plan here as their element of insurance. And this is why the HSA stuff would be eligible. Okay. So they would have a 30-day window come January 1st. If they want to allocate 500 to their HSA and 500 to their WSA, or 800 and 200, whatever they want to do, they can do that within 30 days of the plan renewal, and they cannot change that. So if they don't spend as much as they thought they're going to on their HSA, they can't just all of a sudden go back and now move it over to the wellness side and spend it there. So one more thought there.
Yeah, and that's funny you say that, because my spouse, she works for HS, and we always have this conversation in January. How much dental are the kids having this year versus how much does she allocate for an RSP under the WSA? So we're always guessing in January on how bad the kids' teeth are going to be for the year. So I always laugh at that.
Yeah.
Okay. Well, I think I got one or two more questions that I can ask. Well, people kind of think about maybe what they would like to ask. From a benefits perspective, where do you see the trend? Like, what do you see in the trend, I guess, from a benefits, but more of a retention? Do you see employees looking more for that kind of traditional medical stuff under the HSA or the gym, RSP? Like, where do you see the trends going right now?
We still, I mean, again, I would say this is demographic dependent. So definitely the younger generations, the number one source of feedback we get is flexibility. I don't like that I'm paying X amount per month, but I only get to spend, $300 a year on massage or $500 on massage. I want to spend, and then I have $500 on physio and $500 on psychologist and $500 on all these things, but all I want is massage, or all I want is physio. I wish I had more flexibility there. So that's the number one feedback we get, especially from younger demographics. But honestly, dental, the dental costs have really increased, and the claims have, when we do all of our renewals now, there's two things that stand out in terms of increases: dental and LTD, so long-term disability. There's been a lot of claims, and all the carriers are saying it's just been mental health claims and stuff with COVID and whatnot, but dental is another big one too. So
yeah, it's a very interesting point. We've seen a lot of long-term, or I guess short-term for mental health, and the kind of the breakdowns over the COVID period.
You often see like a shift too, John, where a single employee that doesn't have kids, their needs are going to change. You get married, you have two little kids. When they're little, they don't go to the dentist, but then all of a sudden they start going to the dentist, and that $1,000 that you were using on your gym membership all of a sudden is being allocated to dental bills, right? So you certainly see that shift as people go through their life, and that's why it's nice to be flexible, because what a 25-year-old employee needs is not the same as what a 45-year-old employee often needs, right? Sure, it can be the same, but often those needs are very different. And then on the other end, like a 65-year-old employee would probably have something different that they want as well, right? So
yeah, Scott, I think my phone is blowing up from all my dental clients. We're picking on them. I tell you, they're not very happy with me. So maybe we'll pick on the darn pharmacist. One of the things I think you touched on, Mike, and I just want to maybe reiterate or highlight, is that under the if there's a company that had benefits plus an HSA, that 20% that maybe is not covered on the drug component, it can be run through the HSA. Is that correct?
Correct. Yeah, for sure. Yeah, and that will be the same, John, even for if there's any copay at all. So physio, dental, if it's an 80-20 across the board, all of that difference can be put through the HSA. So not just for drugs.
Yeah, let's not talk about chiros. I got some pretty strong chiro clients, so I don't want them coming to my office.
Well, no,
for bugging them, but their copay as well.
Good. But hey, they would love a plan like that. They would love if all employees had a plan like this, I'm sure.
Yeah, absolutely.
Yeah.
So, Oilers, are they going to make the playoffs?
Oh yeah. Are they going to make it past the first round? I guess is the question we should be asking, because that's where the hang up. That's where the over under should lie, I think. Yeah.
Are there any other questions? Okay, well, I don't want to take. It's a beautiful Friday afternoon, and I think Mike in a couple weeks will be golfing on these Friday afternoons if the sun keeps up. So, I will say my goodbyes, close it off, and thank everyone for coming to Gallo LP's Coffee Chat, talking about benefits with Scott and Mike from the FSG group. I'd recommend you giving them a call. Do we have your contact? Well, I guess the PowerPoint has your contact information.
Yep.
But if anyone has any questions or needs it, I think on the last page was the contact information. But get a hold of them, fsg.ca or Financial Services Group.
Actually, John, getbenefits.ca. Nice and easy. Getbenefits.ca. Can't forget that one.
Getbenefits.ca. I'll say it one more time. Getbenefits.ca. It's almost like Ryan Jesperson, the way he kind of does all this stuff. So getbenefits.ca. That's Johnny Gallo from Gallo LP sign off. Thank you, Mike. Thank you, Scott. I appreciate your time today, and thank you everyone for listening in. Have a great weekend.